The number crossed below 80 last week. It's not a number that appears on most trading screens. It doesn't trigger alerts at major institutions. It won't show up in earnings calls or Federal Reserve minutes. For most market participants, it's a relic, something traders tracked decades ago before algorithmic systems and derivative instruments made such simple ratios seem quaint. The silver to gold ratio, the number of ounces of silver required to purchase 1 ounce of gold. For the better part of 4 years, that ratio has hovered in a range between 80 and 90. Occasionally it spiked higher, occasionally it dipped toward the lower bound, but it stayed contained, behaving the way ratios behave when nothing fundamental is shifting. Then, quietly, it broke. The move below 80 happened without fanfare. No headlines, no special reports from the major financial networks. Silver didn't surge dramatically, gold didn't collapse. The nominal prices of both metals continued their gradual appreciation, drawing occasional attention, but nothing that would suggest structural change. But the ratio, the relationship between them, moved in a way it hasn't moved since March 2020. That month, as the global economy locked down and supply chains fractured overnight, the silver to gold ratio spiked above 120 before reversing sharply. The velocity of that reversal was historic. Within weeks, the ratio compressed from extreme levels back toward its long-term range. Silver outperformed gold by a margin that hadn't been seen in decades. What followed was a sustained period of silver strength that caught most analysts off guard. The metal that institutional investors had largely written off as too volatile, too industrial, too small to matter, suddenly became the focus of intense physical demand. The current move is different in character, but similar in implication. This time, the ratio isn't reversing from an extreme. It's breaking out of a range that has held for years. And the velocity of the move, the speed at which the compression is occurring, suggests something beyond normal investment flows. When ratios move slowly, they reflect gradual shifts in sentiment or allocation. When they move quickly, they usually reflect something structural, a supply constraint, a demand surge that isn't being met, a repricing that's happening in the physical market before it shows up in the paper market. The last time this ratio broke below 80 with similar velocity, silver appreciated by over 40% in the following 6 months. That's not a prediction, it's a data point, one that the current move is beginning to rhyme with. Something is shifting in the monetary metals. Not in how they are being discussed, the narrative remains largely unchanged, but in how they are being priced relative to each other. That relationship has historically been one of the more reliable signals in commodity markets, not because it predicts specific outcomes, but because it reflects underlying stress that doesn't always appear in headline prices. The ratio just told us something. The question is whether anyone is listening. The silver to gold ratio is one of the oldest metrics in financial history. It predates central banking. It predates fiat currency. For centuries, it was one of the primary ways that monetary systems maintained stability, fixing the relative value of the two metals that served as the foundation of commerce. In the modern era, that fixed relationship disappeared. Both metals now float freely, their price is determined by a complex interaction of investment demand, industrial consumption, central bank activity, and speculative positioning. The ratio moves constantly, reflecting whatever forces happen to dominate at any given moment. For most market participants, this makes the ratio essentially meaningless. It's a historical curiosity, not an actionable indicator. The standard view holds that silver and gold are fundamentally different assets now. Gold is a monetary metal held by central banks, while silver is primarily an industrial commodity with a small investment component. Under this framework, comparing them is like comparing copper to treasury bonds. The prices might occasionally move together, but the relationship doesn't reveal anything useful. This view is largely held for the past 2 decades. Analysts who focused on the silver to gold ratio were often dismissed as gold bugs clinging to outdated frameworks. The sophisticated money focused on other metrics: real rates, dollar strength, ETF flows, central bank reserve composition. And for long stretches, the skeptics were right. The ratio fluctuated within a wide range, sometimes compressing, sometimes expanding, without any consistent predictive value. You could construct narratives around the moves after the fact, but trading them in real time was notoriously difficult. The signal-to-noise ratio seemed too low to be useful. This is why most institutional investors ignore it entirely. When you're managing billions of dollars against a benchmark, you don't have time for indicators that work occasionally. You need consistent, reliable signals that can be incorporated into systematic frameworks. The silver-to-gold ratio doesn't fit that requirement. It's noisy. It's influenced by factors that are difficult to model. It can stay at extreme levels for extended periods before reverting. There's another reason it gets overlooked. The silver market is small. Total above-ground silver stocks are worth a fraction of gold holdings. The daily trading volume, while substantial, is dwarfed by major currency pairs and equity indices. For large allocators, the market simply isn't deep enough to matter. This creates a blind spot. Because the market is small, institutional attention is limited. Because institutional attention is limited, price signals can emerge in silver before they appear elsewhere. The metal becomes a leading indicator precisely because the sophisticated money isn't watching it closely. That's the paradox. The same features that make the silver to gold ratio easy to dismiss, the noise, the volatility, the small market size, are what make it potentially valuable when it does move decisively. For years, the ratio has fluctuated without direction. The fluctuations meant nothing because they weren't accompanied by the kind of velocity that suggests structural change. That's what makes the current move different. It's not just that the ratio crossed below 80, it's how quickly it got there, and it's what's happening in the physical market while the paper market remains relatively calm. When those two things diverge, when the physical market and the paper market start telling different stories, the ratio often captures the discrepancy before anything else does. That's not a guarantee. But it's a reason to pay attention when most of the market isn't. The deviation becomes visible when you look at where the buying is coming from. In a normal silver rally, investment demand leads, ETF inflows spike, futures positioning shifts toward the long side. Retail interest, measured through search trends and coin dealer reports, increases. The pattern is recognizable because it's happened repeatedly over the past 2 decades. This time, the pattern is inverted. ETF holdings have been flat to slightly negative over the past several months. Futures positioning, while net long, hasn't shown the kind of speculative buildup that typically accompanies a sustained move. Retail interest, by most measures, remains subdued compared to previous rallies. And yet, the ratio is compressing. Silver is strengthening relative to gold in the absence of the usual drivers. That's the anomaly. Not the price move itself, but what's missing from the move. When you strip away investment demand and the ratio still compresses, you're left with a narrower set of explanations. Either gold is weakening for reasons unrelated to silver, which the data doesn't support since gold has been steady to higher, or something is happening in the physical silver market that isn't showing up in the instruments most analysts watch. The evidence points toward the latter. Reports from industrial suppliers have become increasingly consistent over the past quarter. Lead times for physical silver delivery, particularly for the high purity forms required in electronics and solar manufacturing, have extended. Not dramatically, not in ways that would trigger supply chain alerts, but measurably. Weeks are becoming months in some cases. This isn't appearing in the spot price because the spot price reflects a different market. It reflects the price of silver for immediate delivery through established channels, primarily the COMEX and London markets. Those channels remain functional. Contracts are being settled. The system is operating normally. But the industrial market operates on different timelines. Manufacturers don't buy silver for immediate delivery. They secure supply months or quarters in advance, locking in prices and quantities to ensure production continuity. When those forward contracts become harder to fill, when suppliers start pushing delivery dates or limiting order sizes, it doesn't show up in spot prices immediately. It shows up in behavior. And the behavior we're seeing from industrial users is consistent with anticipated delivery constraints. They're ordering earlier than usual. They're accepting higher premiums for guaranteed delivery. They're building inventory buffers that exceed normal working capital requirements. None of this is dramatic enough to make headlines. It's the kind of quiet adjustment that happens below the surface of markets, visible only to participants directly involved in physical supply chains. But it changes the interpretation of the ratio move entirely. If the silver to gold compression were driven by investment demand, it would be fragile. Investment flows reverse quickly. Speculative positioning unwinds. The ratio would be vulnerable to mean reversion as soon as sentiment shifted. If it's driven by physical supply constraints, the dynamics are different. Industrial demand doesn't reverse on sentiment. Manufacturers need silver regardless of price expectations. The buying continues until either supply normalizes or prices rise enough to force substitution or demand destruction. Historically, when ratio compression coincides with physical market tightness rather than investment euphoria, the moves tend to be more durable. They take longer to develop, but they also take longer to reverse. The current setup has those characteristics. The ratio is moving without the usual speculative fingerprints. The physical market is showing stress that the paper market hasn't fully reflected. The divergence between the two is widening. That divergence is the signal. Not the ratio itself, but the gap between what it's doing and what the conventional indicators say it should be doing. Something is happening in the physical silver market. The ratio is capturing it, and most of the market isn't watching. The silver to gold ratio has compressed sharply on 3 previous occasions in the modern era. Each episode had different catalysts, different contexts, and different outcomes. But the structure of the moves, how they developed and what they signaled, offers a framework for interpreting the current situation. The first occurred in 1979 and 1980. The popular narrative focuses on the Hunt brothers and their attempt to corner the silver market. That story is true as far as it goes. The Hunts accumulated a massive position, silver spiked to $50 an ounce, and the ratio compressed to historic lows before the whole structure collapsed. But the Hunt episode obscured a deeper dynamic that was already in motion before their buying reached its peak. Throughout the 1970s, industrial demand for silver had been growing steadily. Photography consumed enormous quantities. Electronics manufacturing was expanding. Industrial applications were diversifying. At the same time, primary silver production was constrained. Most silver came as a byproduct of base metal mining, meaning supply couldn't respond quickly to price signals. By the late 1970s, the physical market was genuinely tight. The Hunts exploited and exacerbated that tightness, but they didn't create it. The ratio was already compressing before their buying became the dominant factor. When the bubble burst, silver collapsed. But it didn't return to its pre-1979 levels for years. The underlying supply-demand imbalance persisted even after the speculative excess was purged. The lesson from that episode isn't about speculation. It's about what happens when a real supply constraint gets amplified by financial flows. The combination produces moves that exceed what either factor would generate alone. The second significant compression occurred between 2010 and 2011. Silver rose from around $18 to nearly $50 in less than a year. The ratio compressed from above 70 to below 35. It was the fastest sustained appreciation in silver since the Hunt era. The catalyst was different this time. There was no corner attempt. Instead, investment demand surged in the aftermath of the financial crisis. Quantitative easing had raised concerns about currency debasement. Precious metals became a popular hedge. Silver, with its smaller market cap and higher volatility, attracted speculative capital that amplified the underlying investment thesis. But here, too, the physical market played a role that's often overlooked. Industrial demand for silver was accelerating, driven by new applications in solar panels and electronics. Supply was constrained by years of low prices that had discouraged exploration and development. The investment surge happened against a backdrop of genuine physical tightness. When silver peaked and reversed, it gave back most of its gains over the following years. The speculative component unwound, but industrial demand continued growing. The physical market never returned to the loose conditions of the early 2000s. The third episode was March 2020. As pandemic lockdowns disrupted global supply chains, the silver-to-gold ratio spiked above 120, the highest level in modern history. Silver, with its industrial demand component, was treated as a casualty of economic collapse. Gold, as a pure monetary asset, held relatively firm. The reversal was swift and violent. Within months, the ratio compressed back below 70. Silver outperformed gold by a margin that surprised even bullish analysts. What drove the reversal wasn't primarily investment demand, though that played a role. It was the recognition that industrial supply chains were more fragile than assumed, that silver's role in critical technologies made it strategically important, and that the extreme ratio levels didn't reflect sustainable fundamentals. The 2020 episode demonstrated something important. When the ratio reaches extremes, the reversion can happen faster than models predict. The relationship between the two metals, while noisy in normal times, reasserts itself under pressure. 3 episodes, 3 different catalysts, but a common thread. In each case, ratio compression that coincided with physical market tightness produced more durable moves than compression driven purely by speculation. The physical constraints provided a foundation that financial flows could amplify but not fully reverse. The current situation shares characteristics with all 3 precedents. There's no Hunt-style corner attempt, but there is emerging physical tightness. There's no post-crisis investment surge, but there is growing awareness of supply chain vulnerabilities. There's no pandemic shock, but there is increasing industrial demand from sectors that didn't exist a decade ago. The pattern doesn't repeat exactly. It never does. But the elements that produced significant ratio moves in the past are present now in different combinations. That's not a prediction. Historical parallels are imperfect guides to future outcomes, but they provide context for evaluating whether the current move is likely to extend or reverse. The context, at this moment, suggests extension is more probable than reversion. Not certain, but more probable than the flat ratio of recent years would imply. The ratio compression becomes more significant when you examine what else is moving alongside it. There's a signal in the COMEX registered inventory data that does not get much attention outside specialist circles. Registered inventory represents the silver that's actually available for delivery against futures contracts. It's distinct from eligible inventory, which is silver stored in approved vaults, but not currently earmarked for delivery. Over the past 18 months, registered silver inventory has declined by nearly 40%. The drawdown has been steady rather than dramatic, a few million ounces here, a few million there, but the cumulative effect is substantial. The buffer of readily deliverable silver has shrunk to levels not seen in years. On its own, this could mean several things. It could reflect a shift in how warehouse operators classify inventory. It could indicate that holders are moving silver to eligible status for strategic reasons. It could be a technical artifact with no fundamental significance. But when inventory drawdowns coincide with ratio compression and physical delivery constraints, the interpretation shifts. The three signals, emerging from different data sources, start pointing in the same direction: less available silver, tighter delivery timelines, a repricing of silver relative to gold. These things don't usually move together. They're moving together now. There's a second convergence worth noting, and it connects to a sector that barely existed a decade ago. Solar panel manufacturing has become one of the largest industrial consumers of silver. Each panel requires a small amount of the metal for its conductive components. The amount per panel is trivial, but global solar installation is measured in hundreds of gigawatts annually, and the aggregate silver demand is anything but trivial. Projections for solar build-out over the next 5 years exceed anything in previous forecasts. Government incentives in the United States, Europe, and China have created a policy environment that virtually guarantees continued expansion. The manufacturing capacity is being built, the supply chains are being established, the silver demand is already being contracted. Solar manufacturers don't speculate on metal prices. They secure supply based on production schedules. When their forward purchasing increases, it doesn't show up in futures positioning or ETF flows. It shows up in physical market tightness and eventually in delivery constraints. The timing is notable. Solar-related silver demand is accelerating at the same moment that COMEX inventories are declining, and industrial users are reporting extended lead times. Each factor reinforces the others. The convergence creates pressure that exceeds what any single factor would produce alone. This is where the ratio becomes a synthesizing indicator. It captures the net effect of multiple supply and demand forces without requiring you to model each one individually. When the ratio moves decisively in the context of converging physical market signals, it's reflecting something that the component data points only hint at separately. The convergence doesn't guarantee a specific outcome. Markets can remain irrational, or at least non-obvious, for extended periods. Supply constraints can ease, demand can moderate. The signals can diverge as quickly as they converged, but at this moment, they're aligned. And the alignment suggests that the ratio compression has a foundation that leans broader and more structural than a simple sentiment shift. It would be easy to take this analysis too far, to conclude that silver is about to surge, that the ratio will compress to historic lows, that the physical market tightness guarantees a supply crisis. The data points in that direction. The historical parallels support it. The convergence of signals is genuinely unusual. But the data doesn't prove any of those conclusions, and treating probability as certainty is how analytical frameworks become trading losses. Here's what this analysis doesn't establish. First, the ratio compression could reverse without reaching historically significant levels. The move below 80 is notable, but 80 is not a magic number. The ratio has crossed that threshold before and reversed without producing the kind of sustained silver outperformance that the pattern would suggest. The current move could be a false breakout, a brief dip below range before reverting to the mean. Second, the physical market tightness, while real, may be temporary. Supply chains adjust. Production responds to price signals, albeit with a lag. The extended delivery times that industrial users are experiencing now could normalize within quarters if producers accelerate output or if demand moderates. The tightness could resolve before it translates into significantly higher prices. Third, the COMEX inventory drawdown has explanations that don't require a supply crisis. Warehouse dynamics are complex. Metal moves between registered and eligible categories for reasons that aren't always visible to outside observers. The decline in registered inventory might reflect operational changes rather than genuine scarcity. Fourth, the solar demand thesis, while structurally sound, faces uncertainties that could alter the trajectory. Policy incentives can change. Technology shifts could reduce silver intensity per panel. Competing storage and generation technologies could slow solar adoption. The demand projections that underpin the bullish case are projections, not guarantees. Fifth, and most importantly, the relationship between physical market conditions and price outcomes is not mechanical. Markets can remain disconnected from fundamentals for extended periods. Paper markets can set prices that diverge from physical realities until a forcing event reconciles them. The timing of that reconciliation is fundamentally unpredictable. This is where analytical humility becomes essential. The signals are there, the convergence is real, historical parallels are relevant, but none of this constitutes certainty. The institutions and industrial users adjusting their behavior could be wrong. They could be early, which in markets is often indistinguishable from wrong. They could be responding to factors that resolve without producing the anticipated outcomes. What we're observing is a shift in probability, and not a predetermined outcome. The distribution of possible futures has changed, tilting towards scenarios where silver outperforms and the ratio compresses further, but the distribution still includes scenarios where none of that happens. The honest conclusion is uncertainty, informed uncertainty, but uncertainty nonetheless. If the thesis outlined here has validity, certain observable markers should emerge over the coming months. Not predictions with specific dates, but areas where confirmation or contradiction would appear first. The first thing to watch is the spread between spot silver prices and physical delivery premiums. In normal markets, the premium for physical silver, coins, bars, industrial grade product, tracks closely to spot prices. The spread exists, but remains stable, reflecting logistics, fabrication costs, and dealer margins. When that spread widens unexpectedly, it signals that physical demand is outpacing the paper market's price discovery. During the 2020 dislocation, physical premiums spiked to levels that hadn't been seen in decades. Dealers were charging 30, 40, sometimes 50% above spot for immediate delivery. The paper price and the physical price diverged dramatically before eventually reconciling. A similar divergence, even at smaller magnitudes, would suggest that the physical tightness indicated by the ratio compression is translating into real delivery constraints. Watch for premiums on industrial-grade silver particularly. Retail coin premiums can spike on sentiment alone. Industrial premiums require actual supply constraints. The second area to monitor is COMEX delivery behavior during contract settlement periods. Most futures contracts are rolled forward or cash settled. Actual physical delivery represents a small fraction of total volume. But when that fraction increases, when more participants stand for delivery rather than rolling positions, it often signals that physical metal is becoming more valuable than the convenience of paper exposure. The pattern to watch for is an increase in delivery notices relative to open interest. Not a dramatic spike, but a sustained elevation above historical norms. This would indicate that market participants are increasingly prioritizing physical possession over paper claims. If delivery behavior remains normal despite the ratio compression and inventory drawdowns, it would suggest that the physical tightness is either less severe than indicated or not yet recognized by futures market participants. Either interpretation has implications for how the situation might unfold. The third observation point is industrial user behavior as reflected in trade publications and supply chain reports. This data is less accessible than market prices, but it's often more informative. Manufacturing companies discuss supply constraints in earnings calls, trade association meetings, and industry conferences. Their procurement behavior, whether they're building inventory buffers, diversifying suppliers, or locking in longer-term contracts, reflects their assessment of future availability. Solar manufacturers are particularly worth watching. Their silver demand is growing faster than any other industrial segment. Their supply chain behavior will reflect their expectations about future availability and pricing. If they begin discussing silver procurement as a strategic concern rather than a routine input cost, it would confirm that the physical market tightness is being recognized at the industrial level. None of these markers individually would prove anything definitive. Markets are complex. Signals can be misleading. The convergence we've identified could dissipate without producing the outcomes the pattern suggests, but these are the places where evidence would accumulate, where the thesis would either strengthen or weaken based on observable data rather than speculation. The ratio has moved. The physical market is showing stress. What happens next depends on whether these signals intensify or fade, watching without predicting, observing without forcing conclusions. That's the discipline this kind of analysis requires. We started with a number that most of the market ignores. The silver to gold ratio broke below 80, moving at velocity that hasn't appeared since the pandemic shock of 2020. The move happened without the usual drivers. No ETF inflows, no speculative positioning surge, no retail frenzy. Just a quiet repricing that emerged from somewhere beneath the surface of standard market indicators. What we found, when we looked deeper, was a pattern of physical market stress that the paper market hasn't fully reflected. Industrial users securing supply ahead of anticipated constraints, COMEX inventories declining steadily, delivery timelines extending in ways that don't make headlines, but do affect procurement behavior. The historical parallels suggest that ratio compression, driven by physical tightness rather than speculation, tends to produce more durable moves. The current setup shares characteristics with previous episodes that preceded significant silver appreciation. But parallels are not predictions, and the uncertainty that runs through this analysis is not a rhetorical device. It's the honest assessment of what the data can and cannot tell us. The institutions and industrial users adjusting their behavior may be seeing something the broader market hasn't recognized. Or they may be responding to concerns that resolve without consequence. Both possibilities remain open. What's clear is that something is shifting in the relationship between these two metals, a relationship that has served as a quiet indicator of underlying market stress for centuries. The ratio is saying something. Whether the message proves significant depends on what happens next. Nothing demands immediate action. The move is notable, not urgent. The signals are accumulating, not screaming. But in a market where most participants watch the same indicators and reach the same conclusions, the signals that matter most are often the ones that don't fit the standard framework. This is one of those signals, quiet, persistent, and easy to dismiss. Worth watching anyway.